So hello everyone, and I hope everyone is well. So this is where we left off talking about the internal rate of return and its uses. And here's an example where you're computing the internal rate of return for an annuity. So again, an annuity is something that pays constant amounts of money or cash flows over constant periods, okay? Kind of like when you hit the lotto, right? You get a constant payout. So this company here was so impressed with Jessica, right, that it decides to fund her business. In return, the initial capital of $1 million. Jessica has agreed to pay them $125,000 at the end of each year for the next 30 years. So what is the internal rate of return on their investment in Jessica's company, assuming she fulfills her commitment? So if we go back here, notice the cash flow was positive here, and here we were shelling out money. There was a one sign flip from positive to negative. Now here, the company is giving her money, so that's then it's negative. We're looking at it from their perspective. Okay, so that's negative. Okay. And here's the cash flows they expect every year for the next 30 years. So basically what we do here is here's the initial investment and here's the present value of the cash flows being calculated. Okay. So this is the present value of the cash flows being calculated, and we're setting the net present value equal to 0. So we make these equal to each other. So again, remember the whole concept is to set this equal to 0. Okay. Now we don't have to solve this, right? We just simply go to Microsoft Excel, and we take 30. We just plug in 30 years, the initial investment right here. Okay. And we're solving for the rate. Okay. And the payment is $125,000, and the future value is 0. And it comes up with the internal rate of return on this investment is 12.09%. So that's the effective interest rate of the loan. All right. Now, I want to make a point. They're using the rate function here, and I could do that too, but there's another function in Microsoft Excel that you can use that's actually much simpler. Okay. And it's called the IRR function in Microsoft Excel, or the internal rate of return. And let me go and find that. Okay. So if I go here, and you can see I already set up the problem. Here's the initial $1 million investment, and I have 30 $125,000 cash flows that I just populated in here rather quickly. Okay. So you can see here's the function IRR. All right, and let me click on that. And I already did the calculation, but here, if I click on that, you can see I just put the cells in here. I dragged the cells, all these cells, and put them in here. And you can see just all I had to do was do that, and it already does the calculation. Okay. There's a problem, as I said, with Microsoft Excel. You'll get multiple numbers. We'll talk about that later. Okay. So, but if I say OK, you can clearly see it just does the calculation. It's that simple. It's just that simple. Or again, you can use the rate function in Excel. Okay. Comes out the same. So that's about it. Oh, so anyway, as I was just saying, here's Excel's built-in IRR function that they're talking about in your book. Okay. And hold on one second here. I'll fix this up for you. So I had a little hiccup there, but anyway, here's the built-in function, and here you can clearly see what they just did. They just throw in the cash flows and use the Excel internal rate of return, and it calculates the internal rate of return for you. And they have a little blurb here about it, the proper way to use it. Now, there's a net present value function in Excel, but you got to be very careful when you use that, okay? And you'll see what they say here, and we'll talk about that later, okay? So, like the NPV function, the IRR ignores the period associated with any blank cells. And again, they start alluding to the fact that the IRR function has a lot of problems with their solution. All right, so that's pretty much it for that. If anybody has any questions, let me know. So what I want to do now is jump over to 7 and discuss some of the problems, okay? I think it's important we start discussing the problems. So under Chapter 7, which are called Investment Decision Rules, and let me go ahead here, and I'm going to look for IRR. So we'll pick up like here now on Chapter 7.1. We're at 7.1, all right? And net present value, they tie together net present value and the internal rate of return here. Okay? So the net present value of the project depends on the appropriate cost of capital. Okay? And of course, you always have to determine what your cost of capital is. And you know, you have to make your best guess, all right? So one graphs a net present, it's called the net present value profile, which is the net present value for different costs of capital. Okay, or different discount rates. Okay. So you can see here in this graph, I'll scroll down here. You can see in this graph, here's the net present value for different, here's the discount rates, right? And here's the net present value. So they're graphing the net present value depending on what they think their discount rate is. So in this case, if the discount rate is 10%, the net present value is positive 100 million, and of course a positive net present value implies you do the project. Now remember we talked about the internal return is where the net present value is 0, and there it is. Right? So here's the internal rate of return. So you notice anything to the right has got a negative net present value. So if you're going to do a project, you got to make sure your net present value is to the left of this point right here. And this is where you would pick one of these, obviously, for positive net present values. So this is that point, okay, where it's not, anything to the right is not worth doing the project. So the graph shows the net present value as a function of the discount rate, and is positive only for discount rates that are less than 14%, which is the internal rate of return. So given the cost of capital, the project has a positive net present value of 100 million. Okay, so as we just said, it's positive only for rates that are less than 14%. So the internal rate of return basically is going to give you good information regarding the sensitivity of the project's net present value to errors in the estimate of its cost of capital. Okay. So therefore the decision to accept the project is correct as long as our estimate of 10% is within 4% of the true cost of capital. Okay? So in general, the difference between the cost of capital and this is an important point, right? Let me highlight that right there. Let me highlight that for you. Okay. In general, the difference between the cost of capital and the internal rate of return is the maximum estimation error in the cost of capital that can exist without altering the original decision. Okay. And I just want to show you, there's an animation tool here from your textbook where you can actually fool around and check, calculate different projects with internal rate of return here. So here's this blue, this is blue, and here's the curve. And if you just enter data in here, you can, you'll get different internal rates of return. I mean different net present values, right? So the internal rate of return is simply calculated here. So you can see right here where it crosses the net present value is 0 is 20%. Okay. All right. So I just wanted to show you this, and they talk about it right here. Okay. All right. So let me jump. I want to jump ahead. All right, so the next time we meet, I'm going to basically pick up here on 7.2, and really we'll start delving deeply into the problems associated with the internal rate of return. Okay. Alrighty.